Good morning, everyone. This is Larry McMillan. So today we're going to be talking about the market and 2025 and all that. Don't uh, I don't have the gall to say that I'd be able to predict what the market's going to do in 2025 exactly, but I do think we can have some reasonable insights, and we can also take a look at what strategies seem to be working and coming to the forefront. So we're going to take a look at all those sorts of things. So here's just the general outline. We're going to take a year-long look at some of these indicators that supposedly can predict what the market's going to do from an early start. The January barometers are one set of those. Years ending in 5. Presidential cycle is sometimes important. Then we're going to look at some longer-term volatility cycles too, to see where we stand with regard to that, and also long-term put-call ratio charts to see if we can discern where the sentiment of the market is in the longest term. And then, trying to trade a long-term strategy is not something we do too often in our newsletters. We're much shorter term than that. But we did have one last year, about a 7-month trade, which I call the sell in May and don't go away. We'll discuss that and how that might relate to this year. Then on a more shorter term basis, we'll review our current indicators, take a look at some of the products that we've been stressing lately, one of which is the new cover writing high dividend ETFs. Also trading zero date expiration options, where's that sort of stand currently? And then an old strategy that's bouncing back is earnings straddles. So we'll take a look at all of these things and hopefully prepare you for trading in the new year. So January barometers are supposed to be able to predict what the whole market is going to do from what's happening in January. As a mathematician, I find that a little hard to believe, but there is a pretty good track record on some of these. So there's 3 of these January barometers. They were all invented by Yale Hirsch back in the 1950s, maybe refined a little bit along the way, but Yale was pretty good at predicting or taking data and making a system out of it. So first is the Santa Claus rally. That's a 7-day period that encompasses 7 trading days. The last 5 trading days of 1 year and the first 2 trading days of the next year. So that obviously ended on the 2nd trading day of January. Then the next thing that we look at is the early warning system, the first 5 trading days of January. Surprisingly, that has a decent track record too. Now, you have to understand, though, that the market is up, I think, normally about 68% of the time, or maybe even something higher. So, if these things are even slightly positive, there's a good odds that it'll just be in line with the market. And then finally, there's the January barometer, which takes the whole month of January into consideration as far as predicting the rest of the year. So how did these things do this year? Well, the Santa Claus rally actually lost 0.5%. That is not a good sign. The old when Yale Hirsch invented the system, he had a subset to it that most of the time the market, that system is up and the market's up and everything. That's just normal. But if it's down, then he had a saying: if the Santa Claus fails to call, bears may come to Broad and Wall. His son Jeff, who some of you may know from, he's sort of running the company now, said that Yale was a frustrated Broadway lyricist, and he often said stuff like that. Well, whatever. So Santa Claus did fail to call in this case. Now, typically the market will back off for not necessarily the whole year, but it will back off for the first quarter or give you, let's just say, a better entry point into being long for the rest of the year than actually just buying on January 1st. But the other 2 were positive. So the January early warning system was up 0.6%. Not a big deal, but it's still up the first week of the year. And then the whole month of January was up 2.7%, which is pretty strong. And the saying there is, as goes January, so goes the year. So we kind of have a little bit of a conflict with these things. I'm not trading any of them personally for the whole year, but it can be interesting to see what they're saying. And then just as an FYI, we had the Jan seasonal period just ended, and I think the S&P lost 0.02%. It was down like a point or two, which is basically nothing. If you're trading options, though, you lost a little more than that because there was some time decay, especially if you're trading short-term options like we were. The Jan seasonal, it lasts only for 4 days, and I think 3 of the 4 days were higher, but one was a very nasty down day last Monday after the government had announced tariffs, or their intention to do tariffs, or at least negotiate about tariffs, who knows. But in any case, it knocked the market down a little bit and sort of ruined the Jan seasonal for this year. So without further comment, let's just move on. Now, this is a year ending in 5, and that used to get people pretty excited. Using the Dow, which was invented, I think Charles Dow invented the Dow Jones Industrial Average back in like 1892 or something. So there's been, I believe, 14 years ending in 5. So from 1895 to 1995, every year that ended in 5 was a gain for the Dow, and some of them were really big gains. I mean, huge gains. Then that, of course, led to a lot of publicity for the 2005 year, and everybody expecting a repeat. And in fact, 2005 turned out to kind of be a dud. The Dow lost a little bit. The S&P did gain a little bit, but people have said, okay, well, one bad year doesn't ruin the system. And then 2015 came along, and again, another small loss. That was pretty disappointing. A lot of people, I think, in 2015 have really been lining up for this thing to work. So here's the actual data on that. And you can see that on average, the Dow has advanced 26%, even with those last couple of events in there. It's been up 12 times, down 2. In fact, if you count that S&P, that's really only been down 1. And most of the gains have been pretty large. I mean, there's an 81%er in there. You see that. So, but even if we did median instead of average, it's still a pretty big number. So again, here we are, a year ending in 5, and I don't know. When I'm trading, I like to see result. How's the thing been doing recently? This hasn't been doing all that well recently, so I'm not sure I'm really ready to jump in and buy a year-long position. But we are going to talk about that because this could be something that technical analysis is a thing that where a lot of people are looking at the same thing, but if they all start looking at it the same way, then that's pretty strong, and that's really, I think, what makes technical analysis work as opposed to fundamental analysis, which I mean, it's things like targets and all that. That's just sort of, I don't know, it doesn't seem to work. But in any case, so here's a pretty good set of data. Now, go back to here. So there's a website called SeasonX, which I would recommend if you think seasonal trading makes sense, and they have like a whole lot of data. But this is their chart of what the years ending in 5 look like. For the Dow Jones. For some reason, their chart doesn't include 1895, but whatever. It includes all the other ones. And you can see that it's a pretty steady advance throughout the year. Now, there is a little bit of, over on in April here, that does have a little dip in March and then a stronger move in April. You can see that over here on the bottom right where they're have the average returns by month, and so you can see April is actually the strongest month of the year again, of years ending in 5 right here, and March and, well, May and December even are not so great, but they're all positive. If you want to look at the days of the week, which I don't know why you would, but if you do, they have that data too. But Season X has a free subscription. You can bounce around in there and do all kinds of things. It has a lot of seasonal data for individual stocks and things like that. Anyway, moving on, we'll come back to that in a minute, but I want to discuss the presidential cycle as well. So the presidential cycle, a lot of people have attempted to define that over the years. Basically, the market seems to be on roughly a 4-year cycle. Now, I know some of the big cycle traders say it's not, it's different, whatever. But in general, a 4-year cycle works pretty well, and I'll show you some data to support that in a minute. But the theory is that in the first year of a new president's term, he will try to introduce the things he ran on, the political stuff that he was talking about. So it puts that all into effect. And at first it kind of works out okay, but then in the second year of doing that, usually the market gets hit a little bit. And especially year 2 can be a bearish or even a bear market. But then by year 3, the party in power is saying, well, wait a minute, we got to get this economy going again so we get reelected. So years 3 or 4, typically the market rallies as they attempt to, pump the economy. And this cycle goes all the way back. It was, again, Yale Hirsch did some work on it in the 1950s, but I think there's data that extends even farther back than that. And it turns out, we'll take a look in a minute at how these bear markets in year 2 did, but there's been some powerful rallies in year 3 after the bear markets in year 2. And so here's the actual results on this, calculated independently. Bloomberg, I guess. I can't remember where I got the chart. But from 1933, all years inclusive from 1933 to 2024, 1933 being the first year of a presidential cycle, 2024 being the 4th year. And you can see that the second year is a dog, and so the second year is problematic, and the third year is the best. The other 2 are kind of in the middle of those. So, that's something for, worrying about next year, I guess. But this year, we're in the first year of the presidential cycle. So what happens if we combine those 2? We take a look at years ending in 5 and also being the first year of a presidential cycle. Well, there's only been 7 of those. And the first one should be 1895, not 1885, I think. Anyways, the cycle has worked very well, and of course, from the previous chart, years ending in 5 we're doing pretty well, anyways, and we eliminate half of them and come up with this. It looks pretty good. So here we are. We're in. We have both these things working for us, and even though in 2005 it didn't work out too well, still, if you're using S&P, it was up 3%. So this might be something we want to take a look at, and I wrote about this yesterday in the option strategist as well. Before I get into the strategy we might use, let me just give you this chart too. This is about year 2, which doesn't pertain this year. You might want to save this for next year. So beginning in 1962, which is when I really, my early history in trading was around 1970, but I did some quick back research a little bit. But there were major bottoms from 1962 to 2002 every 4 years, just like clockwork, except for 1986. 1986, there was no bottom to speak of. But in 1987, we had a market crash. So maybe the cycle gods or whatever were not happy that there wasn't a bottom in 1986 and really had to pay for it in 1987. Since then, it's been a little spotty, but still basically every 4 years, these are the ones listed in white here, we've had a major bottom. February 2018, we had two of them. This last 2022, we had a bear market from January to October, and that was really the first bear market we've had since 2008. Those ones listed in blue were some other pretty sharp declines in those years, but there's sharp declines in a lot of years. But this pattern of a bottom every 4 years, a strong bottom every 4 years, has been in effect for quite a while. So, for 2026, we might want to keep that in mind. But if we're coming um, to this year, I want to, think about buying something that will work out for the whole year. We're going to get to that in just a second. I probably should have had that slide in here right now, but let me just look at this for 1 second. Okay, yeah, so we'll stick with the format I had here. So we will come back to that and talk about buying an option for the whole year. So another thing that's important, I think, and perhaps more important than those things about years ending in 5 and whatever, is understanding where volatility is, what kind of cycles are going on there. I don't think we have any particular 4-year cycles going on in volatility, but we do have trends in volatility that shift. So in order to look at these, we calculate what's called composite implied volatility every day for individual stocks and indices and futures. And it's described in detail in my book, but it's basically the weighted average of individual option implied volatilities on a single entity. So this is done every day. This day is posted on our website, by the way, in an area called the strategy zone. And we've weighted all those little individual option implied volatilities by their expiration date, where near term gets the most weight, by the volume that they traded that day, and also by their distance out of the money, where at the money gets most weight, and things that are more than 25% out of the money don't really get much weight at all. So this comes up with a composite implied volatility for each stock, what have you. So these are useful in a number of different ways, but a sharp drop in the stock price produces high implied volatility. We know that, but with using composite implied volatility, we can go back and draw a chart. So also, volatility may increase if the market knows that a volatile event is about to happen. Typically, that's earnings, but sometimes it's lawsuits and sometimes it's takeover rumors. So in general, implied volatility trends opposite to the trend of the underlying. This is true whether you're talking about VIX versus SPX or individual stocks or what have you. So here's the chart currently. I just pulled it from the website this morning of Google, and it's some composite implied volatility going back 1 year. So the first thing that really stands out there are those spikes, and those spikes are pre-earnings spikes in implied volatility. So that Google just reported earnings. I believe it was on Thursday. It was big disappointment. The stock dropped like 17, 18 points, something like that. And so it doesn't make that kind of move every time, but people will buy the straddles and hold the straddle price high before the earnings, and in hopes that the stock makes a big move and they can profit on their straddle. So these kind of charts are available. We post a couple thousand of these every day in that area on our website that I call the strategy zone. And they're, without any other analysis, it's kind of hard to discern these, but we do have lists of where the implied volatility is currently higher, very high than the normal and or very low. So, for example, in Google, right in here, that's like the 100th percentile of the implied volatility on this chart. And down in here, that's like the 0th percentile. So if you just look at a list of percentiles, which we have, you can tell where options are expensive and where options are cheap. In any case, we can do this over all stocks too. So this is a current chart. On the top is the S&P 500, and on the bottom is the average daily percentile of composite implied volatilities. So the percentile is the key word there. So, if Google's at 100 and, a bunch of other stocks are at, nothing, then, the total average daily percentile is going to be fairly low. But if they're all kind of high, then other things may be going on. So these percentile scale is on the left over here, and she obviously runs from 0 to 100. So back in 2020, which was just when the pandemic had basically the pandemic crash in the market anyway had just ended, implied volatility was very high. We were almost at the 100th percentile. But then as the market rallied, remember, volatility tends to move opposite to the market. So volatility was dropping. The average composite percentile was dropping as the market rallied. But then we got down in late 2021, beginning of 2020, almost the beginning of 22, and volatility bottomed and started to go up. Then we went into that bear market that I talked about. So that's in the blue box there. It's a bear market for stocks. We were down 27% or so. So that's a decent, normal, I guess, healthy bear market. And meanwhile, not uniformly, but in general, if the composite implied volatility percentile was rising, got back up into the 80s, then the market bottomed and started to rally, and really has been rallying ever since. So the composite implied volatility was dropping all the way through last summer, but about the middle of last summer, really the end of the spring, it bottomed out, and you can see the average composite percentile right in there was probably about 17. It was in the 17th percentile. Now, since then, it's been generally rising. We had that big spike in August that was just a scare thing. It didn't really last, but volatility really did spike there that one couple of days, and now it's kind of trending higher. So my conclusion here is, a tentative one, but it does seem as if volatility is rising and probably will continue to rise this year. So that's one thing we might want to think about when we're talking about strategies. This is a chart of VIX itself, just by the trading day of the year. So it's a 1-year chart. This encompasses 36 years of VIX trading, not the crash of 87, but other things. And you might say, well, wait a minute, I thought VIX didn't exist until 1993, which is correct. It didn't. But the CBOE backdated it 7 years or so to get the crash in there. I'm not including the crash here because it just makes it too distorted. During the crash, VIX theoretically went to 150. We'll never know because it didn't exist. Anyways, so now we have we're right in here, January, beginning of February. Typically, the volatility increases into about March, then falls off pretty steadily all the way through the spring, and it hits a bottom right around the 1st of July. And July is a very low volatility month. But, it used to be people thought, well, August is a low volatility month. It turns out August is not a low volatility month. Last year wasn't, and many other years has not been either. So volatility tends to spike in early August, takes a little breath, and then just continues right on up into September and October. Eventually, we have a big market sell-off in October. Volatility spikes, settles down, and then declines for the rest of the year into point G there. And by the end of the year, volatility's pretty much, it's right back where it started here, roughly the same as on the left side of the chart. So we are still right now in a cycle of increasing volatility. Again, every year is the same picture, but enough of them are similar to this that it's worth looking at, I think. And then we would expect a decline in volatility from like March through through June, and maybe in July we want to start thinking about buying volatility or doing strategies that profit from being long volatility. So I'm going to be discussing here some long-term put-call ratios. I'm just going to give a little background on put-call ratios in case everyone's not familiar with how we interpret them. I don't want to just jump in and throw the chart out there and then people are saying, well, what's he talking about? So put-call ratios are a contrary indicator invented by Marty Zweig, identified by Marty Zweig back in the 1950s when he was getting the put and call volume out of the Barron's ads that ran every Sunday from the put and call dealers of those days. And essentially we look at the put-call chart. We look for local maximums on the put-call chart as being buy signals. In other words, puts are heavy trading, the put-call ratio rising, people are pessimistic, but it's a contrary indicator. So when the pessimism peaks, that's the time to buy the market. And then on the other hand, when their optimism is reigning, the put-call ratio declines, and eventually we get a local minimum on the put-call ratio, and that's a sign of too much optimism, and that's a sell signal for the underlying. So typically, just the way these things work, the way we calculate them, or what have you, we start out with the let's say IBM. We sum up all the puts that trade that day in IBM. We sum up all the calls, divide the two. That's the put-call ratio. Since puts are in the numerator of that fraction, heavy put buying generates higher put-call ratios, higher numbers. But when's it likely that there will be heavy put buying? Well, that's when the stock is going down. So typically, the put-call ratio in this case would be going up, but the stock would be moving the opposite way, going down. And the same thing holds here for call buying. If there's heavy call buying, when the denominator of a fraction increases, the fraction declines. So a heavy call buying would cause, heavy call buying. I'm trying to, here we go. Heavy call buying would make the ratio go lower. But when is there likely to be heavy call buying? Well, that's when the stock is going higher. So again, moves opposite. We keep a moving average for 21 days. So typically, a put-call ratio to me is only useful if you can look at the stock chart and the put-call ratio chart together. And so we publish about 1,600 or more of these charts on our website every day. Again, in that same area called the strategy zone. And so if the stock is declining like this, people are buying puts, they're forcing the put-call ratio higher. Eventually, the put-call ratio forms a local maximum, and that's a buy signal for the stock. So as we said before, then the stock starts to go up. As the stock is going up, move over to the left side, stock is going up. People are buying calls, forcing the put-call ratio down to a local minimum, and a local minimum is a sell signal for the stock. So here's a long-term chart. This is what I'm trying to get to. You don't see this chart too often, but this is the standard equity-only put-call ratio. In other words, just using the volume of puts and calls on all stock options that trade. And this goes back 10 years. We have it back farther. The yellow line is the the 20-day moving average, or actually 21-day moving average. The blue line is 55 days, and the pink line is 10 days. So the 21 day is what we normally publish on our charts, and if you are a subscriber, you recognize the far right side of that chart as being what we've been talking about recently with the standard put-call ratio, and I'll show you that chart later. But this is a long-term chart. So a couple things stand out that makes some sense, I guess. First of all, the highest point in the chart was the pandemic sell-off in the market, forced the put-call ratio there up to extremely high levels. There have been other nasty things happening in the market that push it up as well. This one right here happened to be that big sell-off in December of 2018, but that was even higher. But from there, so that was extreme pessimism. Everybody's very pessimistic. We got the local maximum. That's the buy signal for the market. And then things plunged. Everybody went from extreme pessimism to extreme optimism in really a fairly short period of time. But it's interesting to note here that the extreme optimism began right in here in just the middle of 2020. So we had already dropped from the pandemic low in March to, let's say, June or July, to where everybody's now bullish. And you can see that's the lowest point on the chart up till then. But just because it was the lowest point on the chart doesn't necessarily mean that's the time to sell yet. In fact, that extreme optimism lasted really all the way to the beginning of 2022 when we went into a bear market. So that extreme optimism period lasted for a long time. So right now, let's move over to where we are currently. We're right here where this red line is, which is just about where we entered what I call the extreme optimistic point, back in 2020. So to say that we're really low, I mean we are low, we're the lowest it's been since then. But what if this fell and just stayed down in here for a year and a half or so? So I'm not saying that necessarily this is a sell signal for the market yet. I mean, we are toying with sell signals, et cetera, but you can see from these longer term charts that the put call ratio in a broader sense can fall lower. So yes, there has been a local minimum on the chart for a short-term sell signal, and that's kind of been reversed recently. But in the broader sense, we might just be entering a period of extreme optimism that we haven't seen for a while. The CBOE publishes their own equity-only put-call ratio. I prefer ours because we are looking at all option exchanges that trade. There's actually 19 option exchanges these days. You may not know that. So someone says the audio is garbled. I don't know. Let's see if there's really not much I can do about it. Let me just check my settings here. I've got green arrows on all my stuff. Sorry. So here's the pandemic. Again, of course, that was in the CBOE put call ratio that was also extremely high. Then the extreme optimism period followed. That's also quite similar. But then something happened in the SIBO that didn't happen in the rest of the things, and that is what I've called here an ARB distortion. So some of these high cap stocks like Tesla and et cetera had fallen in price and created these long-term puts that were deeply in the money, and there was an arbitrage that was setting up there, mostly an interest rate arbitrage, but an arbitrage. And that distorted the equity-only put-call ratio quite a bit for the SIBO. And so if you're just using the SIBO data, I think you're getting a distorted picture. It's kind of gone away, that ARB, and so this thing has come back down, and the right-hand side of the chart kind of looks like just like our chart, the previous chart did. You're down here at lows, just sort of about the same as when you entered the extreme volatility period prior to that. Anyway, with the advent of computers along the way, we are able to calculate another put-call ratio called the weighted put-call ratio, or the dollar-weighted put-call ratio. And in that case, we take, at the end of the day, we take an options price and multiply it by its trading volume and come up with the dollar volume. We don't do it on a tick-by-tick basis. We just do it this way. And we sum those up for all the puts, sum them up for all the calls, divide the two. And now this ratio, we're measuring dollars being spent on bullish opinion versus dollars being spent on bearish opinion. So this is the long-term chart going all the way back to 1998 of the weighted put-call ratio. It's a little bit different, and you would expect it would be somewhat different. First of all, the 2002 bear market, which was a very nasty bear market, originally, we were sort of coming into a bear market. Then 9/11 happened, that really hurt the economy. The economy, then market bounced back and then nosedived into the middle of 2022. Now, we didn't have nearly as many stocks back then without listed options. Today we have about 6,000. I think back then maybe you had 2,000. So the ratio could get a little more distorted. Kind of setting that aside, then some of the others do make some sense. We had the financial crisis being a peak ratio. Of course, the pandemic wasn't as strong. In fact, the 2022 bear market, in terms of this dollar weighting, was actually a higher peak in the weighted ratio. And you can see in the bottom of the chart that the ratio hardly ever falls below about 50, meaning $50 are being spent on puts for every $100 being spent on calls. So we're pretty near that bottom on the chart, but it can hang around that bottom a lot. And last year we published an article just trying to take a shorter term look, the last 4 or 5 years, of how the weighted ratio is on top, and on the bottom is the S&P, and those letters, weighted 5 on both sides, are basically where the signals were occurring. I didn't mark them all, but mostly those are the ones that we traded or attempt to trade or what have you in our newsletter. So it does a pretty good job. And it's really one of our better indicators. So right now it's on a buy signal. You can, that's, I'm going to back it up one. It just peaked a little bit on the very lower right hand side of this chart and is declining. And I'll show you that chart later too. Okay, so now back to where I was. Can we possibly trade a year-long signal? In other words, let's say, year ending in 5 plus the presidential cycle, put those two together. I want to trade that. It sounds good to me. Well, last year we had this thing called sell in May and don't go away. We did some research. The old saying is sell in May and go away. So the best 6 months performance of the stock market is to buy in October and sell in April. We've had a lot of October bottoms. I don't know that we've had that many April tops, but that's the best 6-month period to be in the market. But it turns out that so most years sell in May and go away. However, we noticed that if the S&P made a new all-time high in May, then that was not good advice. In fact, you shouldn't go away. You should stay in the market for the rest of the year. So from 1950 through 2023, S&P made a new all-time high 23 times, and 20 of those times the market advanced from June through December. Now last year, that's when we identified it, we did trade it, and it worked again. So now it's 21 for 24. So we'll have to see what happens this year coming up. But we were able to buy some end of the year options at the end of May, so 7-month option, and for a reasonable price, and made a reasonable profit, I thought, on it. But here's where we are right now. This is a snapshot of a montage for real tech trading screen. And on the left-hand side, you can see here that SPY's trading at 602. So if we look at this end of the year, December 31st, 602 call, it's offered at 47. That's pretty expensive. That's over 7%, almost 8% of the value of SPY itself. So the market would have to go up 8% just for you to get even. That's a pretty big step. So you might think, well, what if we spread it? And that's would be the normal thing I think to think of. So the spread would be you buy that call, buy the 602, and then you want to sell something against it. So if you were to sell, let's say the December 640 call, so you'd have 38 points between your strikes. That call brings in 23.50. So your spread costs 23.50. That's exactly half of what you paid on the long side. You're buying the call for 47, and you're selling this call for 23.50. So your net spread is 23.50. At the end of the year, the best you could do is 38. If it widens out to the, if it's above 640 at the end of the year, the difference in the strikes is 38. So paying 23.50 to get 38 is, it's a good percentage return, but I really hope to do better than that, or have it look better than that. So maybe you want to look at the 650 call, and in that case, you're paying 28.30 to get 48. Again, okay, still, these are not too exciting to me. It's very expensive, and so maybe, is there a better entry point? Maybe that Santa Claus rally period is telling you there's a better entry point. So you can either wait for a better entry point or wait for a more convincing market that breaking out over 6,100, because we've had a double top now at 6,100. Maybe if we do break out over that, that might be a time to jump in. But this is high implied volatility. These options are implied up in the 20s, which for SPY options is pretty high, especially longer term SPY options. But it's in line with the CBOE's 1-year volatility index, so it's not like they're crazy expensive and you should be selling them like mad. The 1-year volatility index is over 20 right now. So again, they're just expensive. I mean, that's just the way things are. So I'm not really going to say anything more about that. If we decide to buy those things, I'm obviously paying attention to these things in the Option Strategist newsletter. If we decide to buy those, obviously we'll make a recommendation. Right now, we haven't. So current indicators are these. These are things we look at on a day-to-day basis or write about them all the time. And I think they add up to a pretty good picture on the market. Usually the first thing would be the SPX chart. The next thing to be McMillan's volatility band, buy or sell signals, put call ratios, market breadth, which is advances minus declines, new highs versus new lows, then VIX or the trend of VIX, and then finally the construct of volatility derivatives, which is really just the term structure of the VIX futures. So let's just review these for a minute. So here's where we are right now, and we're in a trading range environment. We had the nice big jump up in the market right after the election, and then there was a where's my I'm having trouble finding my cursor, and then we had a pullback. Oh, there it is. So we had this jump up after the election, pullback, retest this level right here, which had been the previous high, right around 58.70, and then a run to new highs in December. So this is your 6,100 right here, and then we fell back and we tested 58.70 again. And we rallied and we tested 58.70 again. And we rallied and we finally broke through, down through 58.70 early this year for 3 days, just enough to trap the bears, and then boom, right back up on a big gap to the upside. Market raced three gaps. You can see them right here, 1, 2, 3 going higher all the way up and broke out through 6,100 on the upside. And guess what? Fell back again. So we've had a false downside breakout and a false upside breakout, and we're back in the trading range. And this chart's current through last night. So we're in the trading range. So there's really no other way to look at this. And even requiring a 2-day confirmation on a breakout didn't do you any good because you still got caught on both of those. So, obviously, eventually we will break out of this range, and I do think it will be, good momentum when it finally does. But it's been volatile within that range. We moved higher, lower, higher. We've traversed the range quickly a number of times, and that range is, it's over 200 S&P points wide. So it's a move, it's significant moves from one side of the range to the other. Now, I mentioned Bollinger Bands. Those are the wiggly lines on the chart there. The buy and sell signals marked there are what we call the McMillan volatility band buy and sell signals. The blue one was a failure. The 3 red ones were good, but we haven't had one for a while. The market has not moved outside of the 4 standard deviation band in quite a while. We've had the I'm trying to get my cursor again. What the heck is going on with this thing? Okay, there we go. So that's the 4 standard deviation band right there. And the one just inside it is the 3 standard deviation. These signals set up when the market moves outside the 4 standard deviation and back inside the 3. You can see over on the right-hand side of the chart that the bands, the extremes of the bands are like 400 S&P points apart. In fact, that's pretty far apart if you look at the rest of the chart, how the bands are. That's because the market has been volatile within this trading range. So actual realized volatility is pretty high, and it's keeping these bands spread out like that. That circle there on the upper right is the one remaining short-term gap on the chart. I'm kind of a believer that most gaps get filled. They're usually created by a very artificial thing of some sort, news, let's say, and or rumors. And so like we've had a little bit of that recently with, are tariffs good or tariffs bad? Oh, wait, there are tariffs. Oh, wait, there's not tariffs, that kind of stuff. So, there's one, those gaps have all been filled that I mentioned before, except that one. So if it pulled back to 58.70, it would fill that gap. It may do that. I'm not really sure. It doesn't have to do anything. But the point is here that we're still in this trading range, and it's also the trading range is within the bands for the most part. So we're not even getting a signal from the Bollinger Band, McMillan volatility band, sell or buy signal. So we have this service available on TradingView, and it will draw the Bollinger Band and the McMillan volatility band buy and sell signals for anything. So this is the current SPX chart. I just pulled it off this morning. Those little circles there are my circles. The software itself just produces these triangles for buy and sell, but those are the 4 signals that were just on that previous chart. This chart goes back a little farther. It goes back to last May. In any case, you can see that this is a pretty long period of time without having a signal. When you look at the rest of the chart, that this is really the longest time we've gone without having a signal. So when realized volatility is too low, we get too many signals. When realized volatility is very high, relatively high like it is now, then we don't get any signals at all. In any case, you can do the same thing on an individual chart. This is Wells Fargo, but you can look at other ones. If you're going to use this to trade, I would try to make sure that there's been a reasonable amount of success with previous signals, not just some randomness to these. So Wells Fargo fit that definition. Anyway, so we had talked about the put-call ratio charts. Here's the current one, now just going back 1 year, and this is the standard ratio. So this is the one that on the chart is now down at a very low level. the 10-year chart. It's at a very low level, but and it's as low as it was back at the pandemic, and that was this low that's showing at the very low here. But now we're not really doing anything. I mean, we went up here and made a little local maximum, and so I put a small letter B for buy around that. But you'd like to see buys coming from a much higher point in the chart, like these things. Those were all pretty good buys for the market. The market took off after these. Down here at this really low level, I have my doubts about whether that's a real extreme statement of pessimism by traders or not. And meanwhile, we're just since then moving sideways anyway. So really, I'm kind of saying this chart isn't really giving us any real short-term information right now. If we look at the weighted chart, this one is on a buy signal, and it formed that local maximum, and now it's declining. Again, as we saw from that long-term chart, this most recent sell signal at the bottom right here, that's down along the sell signals over time that have been pretty much as low as they go. Remember, I said 50 was about as low as they go, so that's 50 puts, $50 being spent on puts for every $100 being spent on calls. And these other sell signals earlier in the year, which were short-term but still worked out all right. They came from the same level. So we had that, and that was what the decline was in December. And now we've reversed to a buy signal. So we had this little decline there. But, longer term sense, the buy signals up like the ones in the middle of last year were much higher levels. I think I went the wrong way there. So breadth is another thing we look at. This is a chart of our breadth oscillator, which is a very short-term thing. It can swing back and forth rapidly, but it's mostly been way more overbought than it's been oversold because we've been in a bull market for most of the time since 2009. But we did go into a bear market last summer, or in 2022, and so that kind of gave us more of an oversold condition in there. We had, of course, this very extreme in the pandemic, this extreme there in 2018 around Christmas. But now we're back to the point where, we occasionally get oversold, and it happened this past January. And one of my sayings is oversold does not mean buy. So we don't really buy until it stops being oversold. So we bought right there on January 14th. And we're technically still on that buy signal, kind of barely hanging on by the fingertips. It fell yesterday. So this is where it is right now. It fell back to that level. But it needs to stay down there for a couple of days for that to actually become a sell signal. So this is right on the brink of being a sell signal. New highs versus new lows. This is a more of an intermediate term indicator. Doesn't give that many trades. We use the data from the New York Stock Exchange, which is the first three columns here. But I also publish or keep the data for stocks only, and which is all stocks that have listed options, and then also NASDAQ. But in any case, we back here on the January 22nd, as of the 22nd, for 2 consecutive days, new highs had outnumbered new lows, and new highs were more than 100. So that's a buy signal, and that's the bottom right of the chart, or the list of signals. That's the new buy signal, and that's still in effect. So it would be stopped out if new lows exceed new highs for 2 days in a row. It did it one day right here, but not 2. So this is still on a buy signal right now. And again, we talk about this at Candor all the time. But it's really been, I'd say, a great indicator, especially for the last 4 years. So VIX. So the VIX chart is something you should always pay attention to. Spike peaks on the VIX chart are generally buy signals for the stock market. We have a trading system built around those. So the red letter buys were successful ones. The blues were not. Currently, we're on a buy signal right now over here. I can find it. right here. So it's green because it's in effect right now, and that's that last spike peak there. It happened uh, late January when we spiked up to 22 and changed and back down again. We had a little spike last week when the tariffs were announced, but it really wasn't that big a spike. We only went up to just above 20. So that's right there. Geez, I'm having trouble with that. So that was the spike from last Monday. So that didn't even reach the previous spike. So that buy signal's in effect for 22 trading days. So another thing we look at is the construct of the VIX futures, and this can have some importance. I'm going to talk later about how you might want to use this later in the year if things get a little dicey. But in a normal bullish market, the futures on VIX line up in a rising pattern like that. So that's a rising term structure that's bullish for stocks. Occasionally this happens. The term structure inverts, and that's bearish, and it can be extremely bearish. So in March of 2020 in the pandemic, it inverted to a huge number, and that obviously creates opportunities for option traders, but it's also very bearish for the stock market. So here's where we are right now. These are current prices or last night's prices. VIX closed at 1654. Not a big deal, really. I mean, the market was off yesterday, but VIX is, again, not too excited about this tariff news, not panicking over or anything. It might be worthwhile noting that. In any case, the Fed futures of the front month, that's the current, the most recent month. So those futures are trading at 1740. So if we take 1740 and we subtract off the price of VIX 1654, that gives us a premium of 86 cents. So then we look out going out over time, you can see that each futures contract each month is trading at a higher price than its predecessor, which means the term structure is sloping upwards, which is bullish. And they're all trading, of course, at a premium to VIX, which is also bullish. So that's all good. And the term structure is not giving us any warning. The number one thing we look for in a term structure, if for some reason the price of the Fed futures is traded above the price of the March futures, then you start to pay attention really closely, because that usually, if that happens and to any extent, let's say it inverts by 70 cents or a dollar, that the last few times that's happened has been very bad for stocks. I mentioned the CBOE has volatility indices. You actually have 6 of them, from a 1 day, a 9 day. VIX itself is 30 days, 90 day, 6 months, and 1 year. So you can see here, well, the first 2 are inverted because I'm going to say, again, tariffs. A week ago, the market collapsed on Friday from about 100 points from high to low on news that tariffs were going to be instituted. They supposedly were instituted on that next day, although there was some backing off from that. And then Monday, the market was down a lot. So people paid up for Monday options. So this week, again, now there's news, rumors of reciprocal tariffs. So people are paying up for a one-day option. It turns out that, at least according to the news I read this morning, etc., that they can't really institute the reciprocal tariffs yet. So I don't really think Monday is going to be another big down day, but those people did, and they paid up for it. So there's a slight inversion here in the term structure. But then after that, it slopes upwards. And by the way, here's that 1 year volatility for VIX, for SPX. I'm sorry, VIX measured SPX. So one year volatility is 20. Remember, 20.4. We were saying that those implied volatility of those 1 year options is around 21. So that's exactly in line. But in any case, this is still a pretty bullish term structure. It's mostly sloping upwards. So if we put all these indicators together and move them, left side is bullish, right side is bearish, we really don't have anything that's bearish. We have some things that are neutral. We don't really have, the chart of S&P is in a trading range. We don't have a trend of X signal. The breadth oscillators were on buy signals, but it looks like those are coming to an end. The equity only put call ratios are kind of non-committal. And then these other things are more bullish. So still, overall, that picture is not one that should be causing anyone to be panicking or anything right now in the short term. Um, the big picture is we're in a trading range and we're a little bit more, say, bullish than bearish, but still in the trading range. All right, so I want to finish up by talking about some other things that we're going to be looking at and probably trading this year. The first is these high dividend ETFs. We did a few articles on those. I'm going to be doing some more. Most of them are created and managed by a company called YieldMax. And basically what they tend to do is they want to buy a popular volatile stock and write cover calls against it and earn that premium. So their basic formula is this. The first thing they do is they don't actually buy the stock. They create synthetic stock. They buy the call and sell the put with the same terms. So NVIDIA, Coinbase, Tesla, you name it, they're doing this. The second thing they do was sell cover calls against it. And those calls were usually pretty short term in nature. So they get to capture the highest implied volatility, which would be the short term, and then reset the strike fairly often because these stocks move around a lot. So, and then what they were doing with all the cash they had was buying T-bills. So owning synthetic stock and then putting the collateral, the cash that you didn't spend for the stock, in T-bills, that should just be about the same as owning the stock if the arbs are all working right. But in any case, this is how they're doing it. I'm not going to comment on whether that's the best way or not. This is just how they're doing it. And so this was all fine, and they really gained a lot of notoriety by paying out their monthly gains in the form of taxable dividends every month. And some of these dividends are pretty big because they're taking in some pretty big call premiums when they're selling the calls. So this has created, some stir, and people are trying to pay attention. That's why we wrote articles about it and things. But one thing they kind of got trapped last year when some of these big stocks really took off to the upside, and they were left in the dust because they had covered calls written against them. So they amended their prospectuses, and now instead of selling covered calls, what they do is they sell credit spreads. So they sell a call, which is covered by the stock, and then they buy another call farther out of the money. And so that additional long call limits the negative portion of having sold a call against a stock. And if the underlying breaks out above that higher strike price in that credit spread, then they make even more money. So that's what they're doing now in all of these, as far as I can tell. I haven't researched all 40 of them. We've only researched right now, I think 4 or 5. We've written articles about them. We're going to be doing more. And so this is their strategy. And it's been working out pretty well. They have over 40 of these things. Their website provides more information, I think, than any website I've ever seen for an ETF. I mean, they've got the dividend history. They'll show you their current option positions. They'll show you what strikes and what expirations they're in, writing these credit spreads against the stocks, which options they're using for the synthetic long stock, all that stuff. Prospectus is there if you want to read it. They're all pretty much the same. And I just told you what's in them, but again, the fine print, maybe there's something there. They don't necessarily guarantee any payout, but they have been paying out. So this is MSTR on the bottom right here. It's a MicroStrategy. Basically, they just take in cash and buy Bitcoin, and they leverage it. So you can see this last run up in Bitcoin made this stock go from like 100 to 500. On the upper left is the covered writing ETF run by YieldMax against MSTR. It came public at 20. there in February of last year. And since then, it's paid $30 in dividends. That's taxable, but $30 in dividends, and it's still trading in the high 20s. And it's gone X all those times for those dividends. So it's made back all those dividends and still trading at, 30. Well, I think, yeah, yesterday was up even, I guess, yeah. That chart's a week old, but let me just tell you where it closed yesterday. It closed at 26.73, so 27. And I don't know, that looks like a pretty good deal to me. And you don't have to put up with the extreme volatility of MicroStrategy, which is crazy. But again, there's no guarantee they'll keep paying the dividends. There's guarantee they will continue to do covered rights, but MicroStrategy, as I mentioned, is leveraged to Bitcoin. And if something bad happens to Bitcoin, MicroStrategy could be in a lot of trouble, and hence so could Misty, MSTY. So let's look at another one. Here's Coinbase. The chart on the bottom right is Coinbase. Now, Coinbase is the bank for cryptocurrency. It's not really a cryptocurrency itself, but obviously they get a lot more banking business when the cryptocurrencies are doing well and when everything is good. I will say this, I have an account there and everything. If you ever do want to get into the cryptos, Coinbase is a wonderful place to use as your place to hold them, but just make sure you have double authentication on all your logins, because the criminals are constantly trying to hack the Coinbase accounts. Any case, so Coinbase, so YieldMax decided to create one of these ETFs on this. So back here, August, I'm sorry, 23, they issued one at 20 cents. Then it's paid out $26 in dividends, and it's still trading about 14. So that's not as good as Misty, the previous one, but still pretty good. I mean, again, if you believe in the philosophy of banking for cryptocurrencies, this is a pretty good, I think, and a relatively safe way to approach it. Again, no guarantee they'll keep paying out the dividends, but the implied volatility on MicroStrategy is much higher than that it is for Coinbase. So the MicroStrategy calls are more expensive, and so they're paying out bigger dividends. It's just really that simple. So let's look at one that's not one of those. Here's NVIDIA. So in NVIDIA, this I don't know if this was the original one, but in May of 23, YieldMax brought out the NVIDIA covered right ETF, issued it at 20. Since then, it's paid out $25 in dividends, and it's trading at a higher price. It's at 23 and change. And of course, NVIDIA itself has been wonderful and done way better than that. But I don't know. I mean, there was a scare about the Chinese AI thing, until I think they realized those guys are using NVIDIA chips too. So it wasn't so much of a scare as it was originally thought to be. And NVIDIA, is trading up. Well, it closed yesterday at almost 130. So it's in that topping range right there. Again, if you think NVIDIA is a good play, but you're a little nervous about paying this kind of price for it, you might want to consider the covered right ETF. By the way, if you just bought NVIDIA and did the covered rights yourself or sold call credit spreads against them yourself, you'd have the same results. But you're not paying a very large management fee for having YieldMax handle all the details. Then the last one, Tesla. I think Tesla was YieldMax's first ETF. So this one was issued at 40 back here in June of 22. So since then, it's paid $30 in dividends. So not the whole thing, and the price has fallen a lot. It's all the way down to 13. So a couple of things going on here, not all of which I can explain, but one is that Tesla's implied volatility is much smaller than those other things we just looked at. So not taking in as much premium from cover calls. And also, it doesn't look like they participated at all in this last run-up, so I'm not sure what strikes they were using for their call credit spreads, but perhaps they just had their short call strike too low, and it limited their gains on that last big run-up in Tesla. But in any case, again, if you think Tesla is a reasonable approach, but you're a little bit reluctant to buying a $400 stock, maybe you want to consider a $13 covered rights stock, a ETF. So, I don't know, I just kind of repeating what I just said. But again, remember, there's no guarantee of the dividends, and there's no guarantee that these things won't go to zero. They're using leverage in here sometimes. I've even looked, and it seemed to me that they're leveraging the calls that they're writing against the stocks. I have to do more research on that. But there's definitely leverage in here. And where there's leverage, it can, it works both ways. I mean, leverage is neither good nor bad; it just is. But if they're using a lot of leverage and things go the wrong way, then these ETFs could lose a lot of money, just like sort of the Tesla one did. So skip that. On to the next subject: zero data expiration options. So we did a two-part webinar on this last summer, and if you're interested, I would suggest you can find that on our website and buy it and listen to it. But I just want to give you a quick summary of where this market is right now. First of all, I will say I trade these almost every day myself. This is not some like theory thing. I do expect zero-day expiration options on stocks fairly soon. So right now they're just on the S&P and Spider and the S&P type things, E-mini futures, etc. But Apple, Nvidia, Netflix have all been mentioned as potential zero-day expiration options. I would say now that we're getting a new SEC chairman and probably a new attitude by the SEC, that's even more likely these things would pass. So in the beginning, everybody was trying to buy these zero-day expiration options and make a ton. And I guess a few people did, and it was what have you. But now the emphasis, both for retail and institutional, has shifted to selling these things and selling strangles out of the money. So here's just a quick and dirty strategy you might want to think about. Whenever there's an event expected for the next day, there's a real simple formula you can use. The night before, right as the market's closing, price the straddle, the one-day straddle on the zero-day expiration options, and then sell the strangle where you determine the strikes by taking the underlying price plus or minus the price of the straddle. And then the next day, if it breaks out through either strike, just cover, and you probably lose if that happens. But the implied volatility will drop a lot the next day, no matter what's happening. So that's going to work in your favor. So here's an example. Last week on the 29th, GDP was due the next day. So at the 29th at 4 p.m. at the close, these things trade till 4:15. So at 4 p.m. on the close, Spider was trading at 601.70, and the one-day straddle was 530. So 601.70 plus 530 is 607, and minus 530 rounded down is 596. So you sell the 596 put, sell the 607 call, which is sell the strangle, you get a $1.40 credit. Turns out, it says GPI, it should be GDP. GDP the next day was pretty much in line. Market didn't open up very high, didn't close down, it didn't open very low either. And in fact, it just sort of sat there, and these things opened at 60 cents and just took the profit right then. So what if it doesn't work out? So here's one that didn't work out. Middle of January, the 14th, CPI, geez, again, this is wrong. CPI was due the next day. So on the 14th at 4 p.m., SPY was trading at 582 and a quarter. The one-day straddle was 670. So adding 670 and subtracting 670, I sold this triangle. Seemed pretty good, quite a bit out of the money. Got $1.78 for that 14-point wide one-day strangle, so you know you're dealing with some volatility. The next day, the CPI was hugely bullish and SPY gapped open 8 points higher. But that was really just barely through the high strike, and was able to cover the calls for 247. So a small loss, 70 cents or so. Not devastating, not ruinous or anything. And most of the time it works, but this is the worst example that I've had while trading these based on the events. Now there's in the webinar we gave, there's a lot more to it. You can get more frequent trading. You don't have to just wait around for the events by comparing the true range versus the one-day VIX, et cetera, et cetera. I'm not going to say too much about that, except even there, the selling is much more profitable than the buying. We have determined that if you're going to buy a straddle, you probably want to buy a 2-day straddle, just so you don't lose all the time decay in one day. But the buying has been very, very difficult in recent months, many months. You do hit the occasional one. We hit a couple last August, etc. But by and large, buying of the overnight straddles or the 2-day straddles and holding one day has not worked out all that well recently. All right, so what are the strategies that are coming up for this year? Again, we'll be following these all in our newsletter. Earnings straddle buys, those things are back. I'll talk about that in a minute. But Netflix, Google, PTIR, Amazon, they all made big moves after the earnings. Another thing that we're following quite a bit is these hard to borrow stocks using call credit spreads. I'll talk about that for a minute. Then we'll be doing a lot of system trades, the put call ratio, speculative trades, and SPY ratio spreads. We're going to talk about that in general. But say we are expecting higher implied volatility this year. How can we take advantage of that? So there's two ways that volatility can be higher. It can be steadily high, which is like in the 2022 bear market. That was good. VIX never spiked. VIX never went above 40. It was just high, and you could sell out of the money options and do pretty well. The one way that we use to help determine this is the skew index. Skew is the actual thing you can quote on your machine. It's the CBOE's index, and it's basically they take the implied volatility of an at-the-money SPX put and divide that into the implied volatility of a put that's 15% out of the money. So when there's a big skew, means they're paying up for out of the money puts, and so the out of the money puts are more expensive than the at the money put. We keep track of skew as in a chart form and what have you. Basically, if skew's in an uptrend, volatility is pretty much under control. So I'm going to show you two charts of skew. This is a chart from 2020 to 2022, incorporating the bear market of 2022 in here. And the skew was rising until the bear market started. Then it starts to drop. That might be counterintuitive, right? You're thinking, well, wait, bear market, why aren't people buying out of the money puts? But they're actually not. They're actually paying more higher for at the money puts, and they're reducing the skew. Now, if we look at the last 2 years, you can see here that this is up to date through last night. The skew has generally been increasing. That's the 200-day moving average there, by the way. Skew has been generally increasing as the market has been rallying since the beginning of 2023. And so it says 2022 there on the bottom left, but that's really December 22. This is 23 right here. So this trend is higher. So this means to me that volatility is under control. When volatility is under control, we do put ratio spreads, which are recommended in the newsletter a lot, that sort of thing. When is volatility out of control? Well, that's when we get the term structure inverting. And I remember I talked about that briefly, but if the front month of VIX futures start trading at a higher price than the second month VIX futures by, I'm not talking about a nickel, but let's say 70 cents to $1, then that's danger territory. And at that point in time, the VIX futures will begin trading at a discount to VIX. Term structure will slope downwards. And we have this call hedge strategy that's in the past made some terrific profits over time. And it basically is very simple. When the VIX is trading, VIX futures are trading at a pretty big discount. You buy VIX calls to take advantage of that discount. But to hedge yourself, you buy a SPY call too, because if VIX starts to go back down and your VIX calls are losing, that typically means SPY will be going up. So we made, literally a small fortune on this thing in 2008 financial crisis and the 2020 pandemic. The rest of the time, it's been a struggle. We did make a little bit of money with a trade like this in August last year when the VIX was shooting way up and the term structure inverted for like 1 day, 2 days, something like that. But when it inverts for like weeks, that's when you really can make a lot of money with this strategy. But basically, if the term structure inverts, stop doing put ratio spreads or anything else involving selling the options and concentrate more on this kind of thing where you're buying VIX, etc. Now, speaking of buying VIX, can you just routinely start buying some VIX calls? Though, would that be a good idea? They're pretty expensive. To me, they're really expensive. Like the way it works, implied volatility in VIX, is that the at the money is cheap, and then the out of the money calls have higher implied volatilities. It's the opposite from SPX, where the out of the money puts have the high implied volatility. So you need to have some sort of timing indicator, I think, before you start buying these VIX calls. There was a time in the past when the skew was low and all that stuff, you could do it. But with skew this high, it's just not working. But if you do buy VIX calls, you typically want to buy like 33% out of the money, but only go out 2 or 3 weeks, because those are the ones that are going to adhere to the price of VIX when VIX goes blasting higher. So if you own VIX calls at the beginning of last August, great, you made money. The VIX futures only went from about, let's say, 15 to 35. They didn't go with VIX all the way up to 65. You can't trade VIX. You can trade the VIX futures, and obviously the VIX options are based on the VIX futures, so if they're the underlying. But even then, if say it was 15 and you bought the 33% on the money calls, so you bought the 20s and it went to 35, that's you made a lot of money. So we will be watching these things. There was a point in the past where we routinely bought VIX calls. Not so much anymore, but we definitely will be watching this. Another strategy that's coming back is earning straddles. And so the way that we did this in the past was we compare the post-earning straddle move as percentage of the stock price with the current straddle as a percentage of the stock price. And we compared the last 10 moves. So if 5 or more showed greater movement than the current straddle price, we'd buy the straddle. And it worked pretty good for several years. But then once the pandemic hit and all the options got expensive, it just didn't work all that well anymore. But now it's coming back. So I've been tracking it here. We're going to start including this back in the newsletter as a regular feature. But here's the last 10 earnings moves listed here as a percentage of the stock price. 1 day moves now, one day after the earnings. And then this is what the straddle cost for these stocks this last week. You can see 5 of the 6 had pretty big moves and were profitable. Disney did not, but the others had some pretty big moves. So again, Decker was crazy and etc. But this is, I think, a strategy that's coming back into focus now and we will be using it during the coming year. Another one that we have been using and will continue is this hard to borrow stocks. I'll just give you a little background in case you're not familiar with that. But there, you'll find these occasionally. Say the stock is 50, the call is 5, but the put with the same terms is 8. Well, that looks like 3 points for free, right? If you did a reversal arbitrage, you can make the 3 points. But as you know, if you think you're seeing something free, and Morgan Stanley and I used to say Salomon Brothers, and I guess we could say Citadel or whatever, have not picked up on it, perhaps you're missing something. And what you'd be missing here is that you can't short the stock. You can't do the reversal. And so when you can't borrow a stock, you get these distorted prices like this. So what will happen was, let's say the stock is 50, and you can find this deeply in the money put, which should be just selling for 10, but now selling for 12 because you can't borrow the stock. And even more deeply in the money put is also selling for above parity. So you set up a call credit spread. You sell this put credit spread. I'm sorry. You sell that put and buy this put for 9 credit. So the worst you can do is the difference in the strikes is 10. So you sold for 9, you have to buy back for 10. Worst you do is lose a point. But you can make 9 if the stock goes above 70. A lot of these are on volatile stocks, SPAC stocks, crazy things. So we've had a few. I'd say most have not done anything except lose the point. But we did. Misty was how I first got into looking at Misty. Was that there was another one recently, TEM, and now we're in one GRRR. Again, it's approaching the lower strike. All you really need here is for this stock to rise above 61, and you'd make at least 1 point, or you'd get your point back at that point in time. So this is another thing I think we're looking at. I don't know if too many other people are looking at this. Obviously, market makers and people involved professionally are, but I think it's a strategy you're probably only going to find in our newsletter, at least for a while. And then just one last point I wanted to make. A lot of times you want to just buy and hold SPY. I mean, that's been a great strategy, certainly for like kids, accounts or, IRA accounts or something like that. It turns out that I just was a very detailed article recently in the Financial Times, but VU is the same thing run by Vanguard. It's actually a better performer than SPY because it has lower management costs. So if you're into that strategy, consider VU instead of SPY. In any case, that's going to be it. I will take some questions. As a webinar bonus, you're going to get via email a $99 voucher that can be applied towards any newsletter purchase. The PDF links will be emailed to you, but as I said, they're on the right-hand side of the chart here right now. There it says handouts. You should see 2 things there. It says MAC 2025 forecast and MAC 2025 forecast GS, that's grayscale. Our track records of our newsletters are available on the website. We've done pretty well performance-wise, but, no guarantees. The website is new. If you haven't gone there recently, take a look. We also have a YouTube channel. I invite you to be a subscriber to that. A couple of other newsletters as well. So that's our contact information. If you're interested in money management, there's a different website for that. I will say our minimum account size for that is 100,000. Okay, so let me just. How do I undock this thing? Oh, wait. No. Okay. So if you have any questions, there's a thing to the right that says questions. Type them in there. I don't see anything there right now. But what do we run here? Ooh, an hour and a half. I never was going to go that long. Okay. Here's a question. What if you bought puts or sold some calls to hedge when you buy the high yield ETF to capture some premiums when it goes ex-dividend. Okay, well, so the puts on those things, they're expensive. That's why it first came to light on one of those other things, because of the dividend. So as you come up to, you might find that situation in Misty, like the call is 5 and the put is 8. But that's not because you can't borrow it. That's because the dividend's going to be 3. So there's no edge in buying the put. You're paying for the dividend when you do that. Yeah, so there's no edge to that. A dividend is going to be reflected in the price of a put, unless it's one of these things where it's a special dividend. They actually adjust the terms of the options. That's not the case with these things or any other regular stock. But but if you look at a high yield stock, you'll see that the puts seem to be expensive, but that's just because they're discounting the dividend. Okay, well, since it is noon already, if you have a question, just email it to me. We'll answer it pretty quickly. And meanwhile, thanks for attending. I hope you have a great weekend. I'm going to end the webinar now.